You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investment. Now, our guest for this week's show is president of Roll Investment Group and co-founder of For Investors by Investors, Jeremy Roll. Now, Jeremy leads Roll Investment Group's efforts to seek passive alternative investment opportunities in real estate and businesses in the $500,000 to $25 million range. Now, his focus is on low-risk, non-institutional cash-flowing equity investments that are managed by experienced syndicators and then also low-risk secured short-term loan investments. Now, his current investments include traditional asset classes such as multifamily, retail, and office, as well as some very niche asset classes such as mobile home parks and self-storage facilities. Additionally, Jeremy has investments in residential real estate and notes, ATM machines, cash-flowing websites, hard money real estate loans, and other cash-flowing opportunities. Now, here's what you're going to learn in our interview with Jeremy today. You're going to learn what prompted Jeremy years ago to pull all of his money out of the stock market and place it into a diverse range of passive real estate investments. You learned why he feels that passive investments are an ideal fit for busy professionals who are seeking diversity and lack the time necessary to successfully operate the day-to-day of an active investment property. You can learn why Jeremy's been sitting on the sidelines since 2016 and when he anticipates that he'll jump back in. You can learn what his favorite asset classes are and why mobile home parks are at the top of that list. You can learn how Jeremy feels about the recessionary dominos that will fall as we get past the election this November and what he's doing to get prepared for the correction. You can learn how UBI or universal basic income might or might not have a material effect on how severe the post-COVID market correction is. You can learn about the tough road ahead for the hospitality industry and how Jeremy feels about the future of this asset class. You can learn why Jeremy feels that the COVID crisis will materially affect office spaces as we once knew them. And so with that, guys, I'm excited to get onto the show with Jeremy. But before we do it, I do have a few quick housekeeping items I want to run through. First one here is, guys, it's been a long time coming, but I'm excited to announce that we're putting the final pieces in place on the offering docs for our third mobile home park investment fund, which we expect to go live in the next 2 weeks. Now, you could take this as your special invitation to get on our priority notification list for when it goes live. You can simply go over to our website, sunrisecapitalinvestors.com, and click on the Get Started Today button and go ahead and fill out that short form to get placed on our email notification list. Now, I'll tell you that we have a number of exciting off-market deals that we've been diligently working on behind the scenes and look forward to getting things rocking and rolling again, okay? So be sure to go over to Sunrise Capital Investors to get signed up so that you get notified first when we go live. Next up, just want to remind you of the partnership program that we launched a few months back. This is called bringkevinadeal.com. This is where I will partner with you and offer you up to $200,000 of a referral fee for any deal that you bring our way that we ultimately close on. You can simply go to the website, bringkevinadeal.com, review our deal acquisition criteria, and also submit any prospective deals that you'd like to review together. Again, that's bringkevinadeal.com. Moving on here, guys, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, please take a moment to subscribe to the show. And also, if you haven't done so already, leave a rating and review. It helps us attract awesome guests such as Jeremy to the show. And lastly, guys, before we get on to it, I want to remind you of the free 30-minute phone call that I offer each and every week. This is where you and I have an opportunity to connect, okay? There's no ulterior motives here. I won't try to pitch you anything or sell you anything. This is just a way for me to connect with my listeners. I've been doing it for many, many years now. I've talked to hundreds, if not thousands of you. And if you would like to connect and chat about real estate and discuss what it is you're working on, maybe you're a seasoned pro, maybe you're just getting started, doesn't really matter. Again, I would love to have the opportunity to meet you and talk with you for 30 minutes. Go to my website, kevinbupp.com, to get signed up for that 30-minute phone call, and I'll look forward to meeting you. And so now, guys, without further ado, I'd like to get on to the part of the show that you've been waiting for, which is our interview with Jeremy Roll. So here we go. Alrighty, guys, it's my honor to introduce my guest for today's show, president of Roll Investment Group and co-founder of For Investors by Investors, Jeremy Roll. Jeremy, how you doing today?
I'm doing great. Thanks so much for having me back. I really appreciate it.
Yeah, thanks for joining us again here. And I think this will be the third time that you've appeared on the show over the last 5 or 6 years that we've been doing it. And so super excited to have you back. Normally, you and I cross paths at some point during an average year at a conference here or there. I don't know if that's going to happen in 2020. Probably will not. And so hopefully I look forward to seeing you in person again sometime, 2021, let's say, as hopefully the world gets back to some type of normal state. But with that being said, Jeremy, for those that don't know of you, don't know about you, don't know what it is you do, maybe take a few minutes and tell us a little bit more about yourself.
Sure. Yeah. Thanks again for having me on. I really appreciate it. So I call myself a full-time passive cash flow investor. So essentially I started investing in real estate passively through syndications back in 2002. And that was right after the dot-com crash. And I eventually rotated all my money from stocks and bonds into cash flow focused opportunities. A lot of them were syndications, not every single one, but most of them. And then eventually I had a last strong moment in the corp world back in mid-07. I was working at Toyota headquarters at the time, and I decided to take a risk and leave the corporate world at that time. So I've been kind of a full-time passive cash flow investor for about 13 years now, but it's been ongoing for 18 years. And so I spend my day trying to find opportunities, trying to reinvest my money, kind of try to think about what makes sense to invest in ahead, network with a ton of people like you, frankly, because I'm looking up for opportunities all the time, network with other investors, and also network with other investor groups and stuff.
Okay, great, fantastic. I appreciate that. And just for some general perspective for the audience, at any one given time, how many different syndications or passive investments are you typically invested in?
Yeah, so I'm over diversified, hyper diversified. I call hyper diversified really overdone. And I say this because, I'm not joking. This week, I am currently submitting my 2 years of tax returns to get pre-approved for a mortgage, which I've never bought a house before. And it's a nightmare because I have over 60 LLCs. And it's just I'm finding out that causes all kinds of challenges. So I'm currently in over 60 LLCs. I've been in over 30 sales in the last 3 years, to give you an idea. And I'm still in 60 LLCs. Of course, I've reinvested some of that, but not all of it. I've easily been in over 100 deals over the past 18 years, more than that for sure. Because I do it full time and I love the concept of diversification, I try to be as diversified as possible. And it's not like I'm just going into deals willy-nilly, because you know me well, that's not true. Mm-hmm. It's more that I'm just full time looking at deals, networking, and I built up a really big network over time. So just a lot of stuff ends up coming my way.
Gotcha. And regarding different asset classes, what have been the favorite food groups, you could say, over these last couple of years as relates to different real estate asset classes?
Yeah, great question. So look, since the end of 2016, I've been mostly on the sidelines in general as kind of a mentality, just because I've been waiting for the downturn, end of cycle, just looking at all the metrics of when the cycle is going to end. And I'm really low risk. So kind of my whole way of operating the last 4 years was that I was on the sidelines, only went into deals that are very unique with unique pricing. And there are always those deals out there, as you know, but they're just really hard to find. So it's low volume. And I was pushing the sponsors that I was investing with to sell to try to lock in kind of end of cycle time. So what I would say, kind of the better answer, I think, to give you that's more applicable anyway, is, I'm focused on 4 asset classes going forward for the next 10 years that I think I'm most excited about. And I invest for kind of low risk, more stabilized properties for predictable cash flow. Mobile home parks is a great, and I'm not just trying to plug you, but I always do this too. So mobile home parks are one of my favorites because the turnovers are really low. You get a highly occupied park. It's just a really good cash flow play. That's perfect. That's just designed for cash flow investors. So mobile home parks, apartments, self-storage, and senior living. Not senior living, especially not necessarily today near an election and all these other factors, recession. But the next 10 years, that to me are the 4 asset classes are going to probably be my tier ones from a predictable cash flow targeting perspective. And I kind of have been targeting similar type of properties for 18 years as far as profile.
Got it. Are there any immediate impacts that you've seen in your not self-storage, but senior living investments as a direct result of this COVID pandemic? And obviously it's affected a lot of the seniors a lot more than those that are younger in age.
Yeah, I've been very lucky. So first of all, in full disclosure, I'm only in one senior living deal. I've been looking for senior living deals for about, I'd say 3-4 years very actively. Very easy to find new developments because the demand's growing every year now. The population's aging. So there's a lot of new developments. Very difficult to find an existing stabilized facility. People are not selling those, and the investors are focused, and the operators are focused on building, and that's where the money is. And so I'm in one deal. I actually invested in that deal in December of 2019. in that, I knew during a recession for an all cash play type of facility where there's high demand and a waiting list, you're still going to be okay. So it was a good going into a recession type of play. We've been very lucky because there hasn't been COVID in that facility. So we've been very little impacted, very little impacted.
Got it.
Stories. It's probably one of the worst, besides hotels, it's probably one of the worst asset classes in terms of being most affected right now.
Sure. Yeah, absolutely. And we're going to definitely talk about that a little bit more. And, so you mentioned that you've been sitting on the sidelines patiently awaiting since 2016. And before we started recording here, before we jumped into the show, you mentioned that your personality just lends itself to being a very patient individual. However, 4 years of patience, right? That's a long time, right? And I think a lot of folks have kind of think of like, when is the end of this cycle? Like this has been running now for way more years than typical. And obviously there's a 4-year gap between where we're at today versus 2016. That's a long time. And now, even as it sits today, we know that there's a few asset classes that have been significantly impacted, hospitality and retail being two of the big ones. And we'll talk about those in a moment. But, other asset classes such as mobile home parks, such as multifamily, they're still trading at all-time lows or all-time highs, depending on how you want to actually look at the pricing metric. All-time low cap rates, all-time high prices. Right. What are your thoughts on the lag time? I mean, so do you think that we're actually going to enter into some type of down cycle? And if so, what type of lag time might you expect it's going to take before we start truly feeling impacts from it?
Yeah, great question. So this is kind of a complicated talk, but it's an important one. So first things first, in a normal recession, you have what I call recession dominos, okay, that fall. And the most easy way to explain it is that people lose jobs, okay, which then causes them not to be able to afford to live where they're living, and they either have to double up with people or move back home. We're going to just talk about those two asset classes, just to make it simple, which causes vacancy to go up, which causes rents to come down, all things being equal, and which causes net operating incomes to go down. And eventually, if you combine that with fear in the market, stock market goes down, people are concerned about lack of predictability and uncertainty during a recession. Therefore, investor demand goes down, and then you've got cap rates that typically essentially go, I keep getting it wrong these days for some reason, go up. And then, the price of the property comes down. Those are the typical recessionary dominoes. Here's what happened this recession so far, as best as I could tell, in terms of all the networking I've done. We had a period of the normal recessionary dominoes falling for about a month or month and a half. So there were stories I was hearing where people were trying to close on multifamily deals. And these are syndicators have been syndicating for many years. And one of them, I remember they went out and told me that they had about 1/4 of the equity interest that they would normally have. Another one had about 1/3 of the equity interest that they normally had. This is when the stock market was down 35%. Okay. That was those dominoes falling. The government stepped in with unbelievable, unprecedented stimulus and brought everything back to basically its previous state very quickly. And then everything went back to normal from a pricing perspective, a demand perspective, and investors are back in the game, right? But in my opinion, what the stimulus has done has caused a recession to be delayed. Not gone. We've lost 55 million people have applied for, have basically become unemployed at some point. Some of them have been hired back, some of them haven't. That's 2.5 times more jobs that were ever lost during the Great Recession a decade ago. Mm-hmm. This is really serious. And so right now what you have is a bunch of people who are getting government checks, who are able to make payments on rent and food and other things. And the question to answer your question to ask is, how long will stimulus go on for and to what extent, right? So We're recording this at a very interesting time because, Congress is they're not meeting eyes on actually coming up with the Part 2 stimulus bill right now. They've just gone on vacation or recession they basically gone on recess or vacation, whatever you want to call it. And we're going to wait and see what the new amount of stimulus looks like. There's a lot of speculation it's going to be lower, right? What impact will that lower stimulus have on people's ability to pay rents and do these other things we're talking about? It's going to have some impact, right? There's a lot of speculation about bankruptcies happening a lot this fall because no matter how much money is thrown at this, there's some businesses, restaurants can't afford to have 25% of the traffic they had before and actually have a viable business, as an example, right? So there's a lot that's going to happen that hasn't happened yet because of PPP loans and because of government stimulus. So here's my theory, and it's a guess. My theory is that we're going to have a second round of stimulus, take us through the elections. Once the elections are done, that's when we have a whole different ballgame and a different equation, right? Because there's every motivation right now for both parties to do as much stimulus as they can to get elected. But once that's done, We're going to have to see where we land, how much debt we've racked up at that point, how much more of an appetite there is to kick the can down the road. And the big question mark to me to ask is, what are the odds of UBI, universal basic income?
Yeah.
That's my opinion. Okay, and I'm not really reading much about it, but that's just me thinking ahead. For those of you out there who are unfamiliar with universal basic income, UBI, that's the premise that the government will send checks to households, regardless of their income or employment status, on a regular basis to supplement the basic cost of living because of the income inequality that's continuing in the country, right? So you know how people are getting $600 checks right now, supplements right now of a certain household income amount? That's UBI. That's actually what it is. Except this is temporary, and UBI tends to be more permanent. So my big question as an investor is, I want to see, is UBI going to come into effect early next year as an ongoing stimulus? And if yes, to what extent? If yes, to what extent? Because if it does, then what I think is going to happen is the recession that was delayed is going to slowly start to unfold, but that UBI can counter it somewhat. And then and based on that, I have to change my expectations about how good a deal I'm expecting to get in a year or two when all this actually unfolds. Right?
Yeah. No, great points there. I want to interject real quick if I could, and I want to make the assumption that UBI doesn't happen,
okay.
And that that the stimulus will, some type of stimulus, although they haven't agreed upon phase 2 yet, but some type of stimulus will ultimately carry through the election.
Okay.
At this point in time, multifamily, mobile home parks, just residential rentals. Let's classify it as that. Okay, whether it's single family, multifamily, mobile home parks, doesn't matter. Like residential rentals have been very, very stable through this period of time. Whether it be A class or workforce, right? The different spectrums there. What's your opinion as it relates to assuming the stimulus does not continue? Do you think we could take a broad brush stroke and say that, residential rentals will also be impacted, both, A class all the way down to workforce, or do you think one of those sectors will be impacted greater than the other?
That's a great question. And I haven't thought it through to that extent, to be totally honest with you, because the way I focus on Class B assets typically, and that's what I most focus on. And I'm pretty sure they're going to be impacted. And what I will say as well is that, the timing at which you were asking about the timing, and I think it's a very important question. In a normal recession, it takes a year or two for prices to bottom out. It takes about that much time for all this to unfold. So if the recession was delayed until January of 2021 in the scenario you just laid out, then it's going to take another year or two for the asset prices to really trough. And we're going to have to wait a certain period for what I call the bid-ask spread, or pricing, what people are willing to sell at versus what people are willing to buy at, eventually comes together. That's going to take several months or longer, right, to even begin to play out. So this isn't all going to unfold in January of 2021. The first domino may fall in 2021, right? But going back to your point, look, one big factor of what you're asking is, what will the jobs look like then, and how many jobs will come back, right? And assuming there's no more business supplemental, PPP or anything else, that's really not going to look pretty. And I will say that one thing I think we can all expect, unfortunately it's been happening, is that wages, there's a lot of slack in the workforce. So that means that the people who are hiring in the driver's seat, they can actually dictate the wage, and wages are coming down, which rarely happens, right? That's very unusual. So if anything, you've got to take that into account as well. So there's a lot of factors at play. Wages are going to come down, I think, across the board, even all the way up to the top. Right. So I think everyone's going to be impacted. I think it just so broadly stroked this whole thing. Yeah. And I think that I'm just trying to get people to understand this whole thing's been delayed, but it's not gone. Yeah. And also this V-shaped thing is unrealistic as far as how quickly the jobs come back. I call it like a square root. And, it's kind of like down, and now it's come back a little, and now it's going to go sideways slowly up. We can only regain jobs so quickly when we're losing all these businesses, and there's no money for them to start new businesses. Like, this is what happens in a recession. It sucks. It's really unfortunate, but the dominoes have to fall. Now, the only way for the dominoes to not fall is with the additional stimulus that you and I are not discussing right now.
Yeah, and I want to make sure that we hit some other points here on the show, but no, I appreciate the feedback there, and I think simply put, there's going to be a great deal of pain. We just don't know exactly where that pain is going to be concentrated, thereafter the election, because I think that's really if there's another baseline that we need to look at, it's the election, right? Things are going to be kept propped up until we actually pass the election point, and then then it's just a Hail Mary after that point in time, depending on who takes office. So, and no one really knows. No one's a future teller, so we can't tell. We just got to plan for the worst and hope for the best. And so my question to you would be, you've been really patient for the past 4 years. Can you maintain that patience for another 2 years?
Yeah, it's not a problem for me because I've already got like all these different cash flow sources. Most of them are performing very well, thankfully. Yeah. And I'm just the kind of guy, I'd rather wait for the right timing. I'm just a very patient guy. Yeah. So, and being a passive investor is very different than being an active investor. Depending on the position, I don't have any employees. There's all kinds of factors, right? So I can sit around, and if I've got enough cash flow streams coming in already, that's okay. Now, I want to be clear. I've still been reinvesting since 2016. But it's been unique deals. It's just been a much slower pace than what I'd hoped, but what I would normally do. So that's where, now I will tell you this, I haven't made a single investment since February, and nothing's been nearly compelling enough to me to really overcome all these other question marks. With the election coming up, I probably wouldn't have made an investment in general, even without a recession, this close to the election to begin with, just to see who's going to come in and what changes are going to happen and how that impacts everything. So I don't see myself making any new investment this year. I should say I made one investment that's not real estate related since February. That has to do with debt and has to do with people who are having trouble paying their credit cards and all this. So like it actually works well at this time as far as like, in terms of predictability. But it's a tough time right now until 2021 for sure.
So we can all agree that the effects of COVID are real. And, we're talking about multifamily and mobile home parks. We talked about, senior living a little bit. And, the two big elephants in the room, the ones that, took the brunt of the impact right out of the gate and still continue on with taking the brunt of the impact have been hospitality, number one, and then ultimately retail. And so my question for you, and I know that those aren't two, I'm sure you've invested in those asset classes in the past. I know you probably researched them a ton, but they're not, two of your favorite. However, my question would be, do you feel that hospitality and retail, as we once knew them, could they experience a full recovery after the effects of the pandemic pass?
Yeah, great question. So disclaimer, I've never invested in a hotel. I've always stayed away from that because the average daily rate changes every day. And so the predictability just isn't there for me. Also, I'm invested in multiple retail strip centers and even a couple office buildings, even a big enclosed mall in Canada. So I'm in probably about 10 retail related or commercial. Okay. And so I'm very familiar with that. I've certainly seen what's, both in Canada and the US or what's been unfolding. Okay, on hotels, my opinion about this is that, look, if you think about it, there was a pandemic in 1918, right here. Do we have hotels now? Yes, right? So the way I like to think about it is that I think with a lot of media hype, people tend to think, oh, this is never going to be the same. But in my opinion, the hotels are eventually going to come back. Because business travel will eventually come back because we'll likely eventually have a vaccine and everything will probably get back to normal at some point, right? The question is that going to be 2021, 2022, 2023, right? I know a number of investors I've spoken to are looking at it as a big opportunity. If you can buy a property at 25 cents on the dollar that's vacant right now, that's purposed for this, sit on it for a year if you have to, or just grow it slowly. In 3, 4, 5 years, that could be a really interesting situation. That's the kind of thing I do as an investor, but I see that being a very interesting strategy. And that's my opinion. I think that things will eventually get back to normal. Eventually, you and I will eventually be going on vacations, places. People will be going out to dinner. Everyone's going to go to the movies. It's just going to take some time. So that's my answer to that question.
And as far as retail, how do you feel about that? I mean, I know that you're in retail. Are you in service, mostly service oriented retail, grocery anchored retail? I mean, there's obviously different types of retail, different markets, different locations, what have you. But there's, I think right from the get-go, there's been a lot of talk, again, a lot of media hype related to, for example, some of the big restaurant chains simply not paying their leases, right? Like they literally can't be open or they're opening at limited capacities and they can't survive based on the current lease agreement that's in place. And so that's obviously, that trickles down to the landlords, the owners of those properties. And so do you see a bloodbath ultimately occurring in retail as well as a fallout from the pandemic?
Short answer is yes, and it's already started. Yeah. So just to go back for retail is an asset class I kind of dropped as of about 2015. I don't think I've invested in one since then. And that was because of the lack of predictability due to more and more people buying things online. That's the way that I looked at it. To your point, though, when I did invest in retail earlier, I was specifically in stuff that was service oriented that couldn't be duplicated online. If there's a restaurant, if there's a nail salon, if there's a hair salon, if there's a gym, those types of things. Not all of them are immune to pandemics, but a lot of them do well during downturns in general. So, and also even with the internet. And so I think that eventually some of those centers can work out. The question is whether they'll be able to bridge the gap in the meantime, right? The CMBS mortgage defaults have just skyrocketed. It's not surprising. And, those typically cater to retail strip centers, retail enclosed malls, office. And there is something that Congress has floated recently. It hasn't been widely discussed. I think it was like a $750 billion stimulus program for that was actually targeted to office and retail as priority with CMBS lenders to be able to provide preferred equity instead of debt or a loan or a forgiven loan to owners, landlords to use to bridge through some of this challenge going forward. And that was basically to try to help some of the CMBS lenders. I think it's more so the CMBS lenders than the landlords because the preferred equity gets wiped out. So the government gets wiped out in the event that it's foreclosed, right? So just helping to make some payments. We'll have to see if that actually comes to be, because $750 billion for CMBS like loans specifically is a lot of money for that sector. So we'll see. I do think, though, that as of next year, once there's a vaccine, I think things will pick up. And the question is, did you have enough reserves? And were you lucky enough to have the right tenant mix to get? I'm going to share a really quick story. I'm in one retail strip center in Houston, really nice center, built I think in '08, great development, developed community behind it, really right on a frontage on an express. I don't know what you guys call it in the U.S., but essentially a service road off of a highway. I don't know if that makes sense. So the road right off the highway. In any event, we had an Ace Hardware. They were the anchor tenant. They basically closed shop last year. We had Dollar Tree come start to negotiate with us in February before the pandemic and wanted that space. Literally, they did not flinch through the entire negotiation. They didn't try to retrade the price. They did nothing. They went all the way through to the end and signed the lease in June and took possession in July and started building it out. So, there are some retailers that are well positioned to take advantage of it. Did they get a good deal on the rent? Yes, they always do anyway. They have huge leverage. Are they a great win for us? Huge win for us, right? At the timing. But I think that there will still be retail strip centers going forward. It's just a question that some of them are not going to make it through, some of them will, and some people will have an opportunity to buy them at very cheap and then either repurpose them or just get them rented up again. Yeah,
that's interesting. Very few times you see Ace Hardwares go out of business. So anyway, that's interesting to hear that happened there. Maybe that wasn't exactly the case, but very rarely have I ever seen that occur. How about office? Let's talk about that sector. I mean, obviously everyone's working from home at this point in time. A lot of companies have realized that their employees can be as efficient, if not more efficient, actually working remotely. They force some of the old timers to, adopt the not new technology, but the technology that's existed for a couple of decades now, Zoom, Skype, what have you. And they're realizing that they might not need the office space. In fact, I mean, we, interesting timing on our part, but our company has had an office space for many, many years, and our lease was coming up in March, at the end of March, and in the beginning of the year, we made a company-wide decision that we weren't going to renew the lease. It's just we communicated a lot via Slack, even while we were in the office together, and there'd be days and times where we were all there, but we might not interact with one another in person, but would via Slack, which it's kind of like, well, why are we spending $5,000 a month on an office lease when we can surely be just as efficient at home and have a little bit more flexibility and not waste that hour or, whatever it might be, commute back and forth in into the office every day. And so we, decided to end the lease. COVID hit. Perfect timing. We wouldn't be working on that space now today, and we've exited out a $5,000 responsibility. I think there's a lot of other companies that probably, maybe not that exact scenario, but are going to, they've quickly realized they might not need all that space again. And, if they do need space, it's going to be a fraction of what they did, or they might not need it at all and will not renew that lease. And so, most office buildings have it could be a 3, 5, 7, or 10-year lease, depending on the type of tenant, type of build out, what have you. What are your thoughts on the overall impacts on traditional office space, but also the lag time that exists there? Like, the folks that have 2 years left that ultimately will not renew at the end of that 2 years. Do you think that office is going to go through a downturn as well?
100%. And I think what's really tricky about investing in office today is that lack of uncertainty going forward, right? And that lack of predictability. of what's going to happen with these remaining tenants. So you've got to get ultimately a fantastic deal if you want to make any run of buying a building, even in a year or two, right? Because to your point, some of these leases may be 3 years and then they'll be out. So, it's interesting. What always worried me about office and why I haven't invested in office, I have one office investment in the US right now. It's in Columbus. And I have a couple in Canada, but these are from a long time ago. And the reason why I've been worried about office the past years is because of the lack of predictability, because people are constantly like, you have people moving into urban core, and then now you're having them moving back to the suburbs, right? And then, so there's like the uncertainty of where is that office demand going to be in a few years, combined with, and this is me, I have to think very far out when I'm investing, because as a passive investor, I get locked into a liquid investment, and I have to think 10 years out, combined with self-driving cars, right? And how that's going to impact is someone willing to commute further, potentially from where they live to their office. You have flying drones eventually going to come up. That's going to make a commute much shorter, and it can make, office more desirable in certain areas where it's cheaper as opposed to where you think the right location is, right? And all kinds of other stuff. And so the predictability of office has become really challenging going forward. And the funny thing is, I never even considered telecommuting because it was already happening, but to the extent that it's happening today, it wasn't, right?
Right.
Shift, I think, was going to happen slowly over time along with these other things, but I never considered that abrupt shift. So it's a really tough asset class for predictability. Now, I will say this, the office building I'm in Columbus happened to have had a tenancy that are essential businesses. We had one big medical tenant. We had one big telecommunications tenant. And so the irony is that if you look at all my retail strip center investments in the US and then the Columbus building has the highest collections in COVID compared to all the other retail centers. And you wouldn't necessarily assume that, right? When you think about the carnage. And so it is a bit of a luck factor, and depends on who the tenants are as well.
Yeah, no, great feedback. I appreciate that, Jeremy. I'd love to pivot and switch gears before we run out of time here. And I want to talk about passive investing, and just that's what your focus has been. You haven't really gotten on the active side at all. And so if you could maybe kind of outline, what you perceive to be some of the biggest benefits of being a passive investor versus an active investor, and why you never ventured into that side of things.
Yeah, sure. So good question. So first of all, I would say a lot of it, I think, has to do with personality fit. Some people are better suited. To me, when I invest passively, I trade control for diversification. I also get to leverage people's time, expertise, money, credit, team building, and everything else, right? And each of those are very important factors. But in the end of the day, I started off in 2002 when I was working at Disney headquarters. I was crazy busy for my job. I did not have time to do anything active, so I went passive. Turns out that I was okay giving up control to people and got comfortable with it very easily. And I continue to be okay with that today. And I frankly love the concept that I can make an investment with someone like you in mobile home parks and someone else in self-storage and someone else in senior living. There's no way I'm going to be able to learn all that myself properly across all these asset classes from a diversification perspective. So I trade control for diversification in my thought process of how it works. But I do come back to the fact that I have a lot of discussions with newer investors all the time, and they're trying to figure out whether to go active or passive. Active will make you more money because you're putting your time in, right? You'll have all the profit, so to speak, or more of the profit. But it is somewhat of a personality fit. Some people don't like the concept of investing out of state. They want to be able to invest where they can drive to locally. That's a tough thing to do passively, to really find the right types of deals and the right diversification, right? And so that person might be better suited active. Someone might be too busy at work. They're going to be better suited passive. And so it really depends on the circumstance. But you got to make sure it's a personality fit for you, because all these investments are highly illiquid. You won't be able to just press the button on your screen and sell them in 3 days. So if you go down the wrong path, reversing from that path is very challenging. You want to think it properly through up front.
Yeah, no, great points there. And how about someone that's just getting started? Typically to be a passive investor, I'll use you as an example. So you're leaving the corporate world, like you had a substantial amount of money. I don't know how much that was, but you had a stockpile of money that you could essentially take out of the market and diversify into different syndications or partnerships in real estate. And so, but are there ways for someone that's just getting started with little cash? I'm not going to say no cash, no credit, what have you, but like just someone that's an intelligent individual that doesn't have hundreds of thousands of dollars or millions of dollars, but has got a good brain on their shoulders. Is there a way for them to get involved as a passive investor? They don't want to go down the road of learning an asset class and being on the active side. They want to be on the passive side. Are there different structures out there that would allow that individual to get involved?
Yeah, so I'm not a financial advisor. I think I'm sharing here just my perspective as an investor. I will say this, someone who is a little bit lower, either in net worth, income, et cetera, still has some options out there now. With the advent of the crowdfunding laws, the Jobs Act that passed in 2012, there's been a number of things come up. And so you can take a look online at some of the crowdfunding portals, for example, like Realty Mogul and many others. And they offer non-accredited investors, smaller investors, the ability to go invest in $500, $5,000 type increments. And why I think that's very important is not just access, but it's diversification too. Mm-hmm. Because if you've got $50,000 to go into a few different real estate deals and you just go into one deal, this all eggs in one basket thing to me is not at all a good idea. I'd rather, if it were me, I would rather spread that across 10 different crowdfunding sites at $5,000 each, and just in terms of the way that I think from a risk perspective, right? So the other thing I think that's going to be interesting is I believe the SEC proposed changes to the crowdfunding laws recently that will increase what's called Reg CF, which is the smaller of the two crowdfunding structures, from 1.07 million maximum to 5 million maximum potentially. Now you can imagine if that opens up to all the way to 5 million, that's going to enable a lot more real estate operators to potentially use Reg CF type of structures to allow for crowdfunding and allowing for much smaller investors if they want to go down that route. And I think it's going to be very interesting to watch for real estate investors. It hasn't been discussed much at all because it hasn't been finalized yet, but I think it's going to end up coming up and it's going to be interesting. But the long answer to your question is crowdfunding is probably one of the best ways because it enables smaller chunks of money. There are challenges associated with it. Those are intermediaries. You've got to really do your research on who you're investing with. You've got to analyze what you're investing in through them. Returns are lower because there is an intermediary. There's all these factors involved, right? But that is one great way for someone to invest who's a little bit smaller and still get a lot of diversification.
Have you successfully gone down that road and invested with a crowdfunding site or through a crowdfunding site? So
the disclaimer is I'm actually an advisor for Realty Mogul. I've been an advisor with them since before they launched back in 2012. I've never, ever invested in a crowdfunding deal. And the reason is because I built a network up to be able to find deals directly, and they're an intermediary. And so they provide a great service to the right person, someone who's maybe busy at work who doesn't have time to network, someone who lives in a remote area who won't be able to build a network, or someone who has less money and they want to chop up into smaller amounts and can't afford the regular minimum investments. Those are all great solutions. For me, never invested in a crowdfunding deal just because of the fact that they're intermediaries. So it's the same risk for a little bit lower return if you're able to find those deals directly.
Got it. No, great feedback there. And, for those folks that are listening that, maybe have not invested in a syndication, you build a network. It's taking you many years and years to build that network. And you put your hours in to actually meet those different folks, all the active sponsors that are out there. But what would you suggest to be, maybe, the top one or two ways that those that are, again, listening that are seeking to make some passive investments to actually go out and to start building their own network and find outside of the crowdfunding sites, but find those active sponsors that are seeking equity?
Yeah, if you can afford the regular minimum investments and say you're an accredited investor, for example, there's a few different possibilities. Networking is very important. There are sometimes local networking events on meetup.com. They're virtual at the moment, but they're still a great way to network. Conferences that you and I have been to, they sometimes hundreds of people show up, and that's a great, really efficient way to network with people. And there's a number of them across the U.S. every year. Podcasts like this, you host a lot of great operators and other people who people can listen to, decide if they like what they hear, and maybe contact them. That's another very efficient way to look at it. Those are the three of the quick ones coming to mind immediately. Ultimately, people who are out there who aren't familiar with this need to understand that the majority of opportunities are not allowed to be publicly marketed in the way that they're structured and the laws that the SEC puts in place. That's why we keep talking about networking. You've got to find a lot of these deals through networking. And that's really key. And you can use some of these other tools we talked about to potentially find deals as well.
Yeah, no, that's great. And I appreciate that. And Jeremy, you've shared a lot of great information here today, like you always do, always just full of tons of golden nuggets. And what I'd love to ask of you as we kind of round this show out is if you had just one final golden nugget of advice or wisdom that you could leave with our listeners here that might inspire and motivate them as they progress in their very own real estate investing career, what would that one last golden nugget be?
Yes. So I would say right now, patience is a virtue if you can be patient. At the same time, what's really cool about the patience is that, unlike maybe someone like me who just sat around for 4 years waiting for a downturn, right, which is a long time. And by the way, it's extremely frustrating. I'm not going to say it isn't, okay? Very frustrating. We're about to go from, an uncertain period of time where it makes sense to maybe hold out a little after the election, see what happens, to probably one of the better times to invest, or maybe the best time to invest from a cycle timing perspective, right? So we're about to turn into potentially the best time to invest pretty soon. So I would encourage you to just hold out for a little longer, be patient, but there should be some interesting opportunities ahead, probably in 2021, 2022.
I agree with you. That's great. Phenomenal, Jeremy, as always. And so for those that want to learn more about you and what you've got going on, or maybe reach out to you, what's the best place to find you?
Yeah, sure. So don't hesitate to reach out to me if you're new, brand new investor, and you just want to, brainstorm or need some help. If you're existing investor, you want to network. If you're an operator, you have deals. If you're another investor group and you want to network, I'm happy. Anyone can reach out to me. Best way to reach me is my email, which is jroll, JROLL @rollinvestments, ROLL investments with an S.com. So jroll@rollinvestments.com.
All righty. Good deal. Jeremy, it's been fun having you again, my friend. Looking forward to catching up here again soon.
Yeah, thanks so much for having me on. I hope this is helpful for your listeners.
All righty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.